This is the Alhambra Investments Weekly Market Pulse with Alhambra CEO Joe Calhoun. And Joe, I have to start off this morning with the title of this week's report. You called it Opposite George. So tell me what you mean by that and what lessons investors have to learn from that.
Well, it's a Seinfeld reference. For those of us who watched Seinfeld throughout the 90s, it was an obvious thing. But I was at dinner. My wife and I went to dinner with two other couples recently. Last week, actually, and we were at this restaurant. We went to see this woman singer that we really like here, a lady named Krishna Deddy, who's just this wonderful, wonderful singer. Anyway, we went to this restaurant to see her play, and this one woman was talking to me and saying, I don't really understand, why did the market go up so much? The GDP report was negative, and so we're in a recession. So shouldn't I be selling stocks? And so I started explaining to her, that no, well, the market looks ahead, and the market tends to bottom about 4 months before the end of the recession. So you have to be a buyer before it's clear. And she just looked at me and she says, opposite George. And I thought for a second, and I was like, well, yeah, that's actually a pretty good way to think about investing. So there's this Seinfeld episode called The Opposite, where George Costanza just laments that everything in his life is the opposite of what he thought it was going to be. And basically says that, my every instinct is wrong. I should just do the opposite of whatever I think I should be doing. And he does that, and things start working out for him.
I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite.
Well, I think in a lot of ways, that's what you need to do as an investor. You need to do the opposite of what you think you should do. And I would put it a little simpler. I know someone, a guy named Larry Gatto, who was my mentor when I first got into this business, an old Italian guy, had been in the brokerage business forever. And he said, whatever the easy thing to do is, that's the thing you shouldn't do. Whatever the hard thing is to do, that's the thing you ought to be doing a lot of. And that has that advice has served me well in a 30+ year career. So that's kind of what it means.
Well, let's talk about that GDP report that you mentioned. It came out, second quarter of negative growth. I am not going to ask you whether we're in a recession or not. That's a whole political fight that we won't go into. But tell me about the negative growth when it comes to trade and inventory. I mean, there was much more than just, we had negative growth.
Yeah, look, the first quarter was really about trade, and there were a variety of reasons why the trade deficit expanded pretty dramatically in the first quarter. Part of it was China shut down. I think some of it had to do with the Russia-Ukraine war. There was an obvious change in our export number, and I think a lot of that was to do with petroleum products. It doesn't really matter. It was an anomalous thing. So trade subtracted 3.2% from the first quarter GDP. Well, if you think about that, if that had just been a flat number, which it probably isn't going to be, but if it had been zero, then we would have had a positive first quarter. So that negative first quarter GDP growth was about trade. I said last week, not this commentary, but the previous commentary, I said, look, this is going to reverse in this quarter, because we know that the trade deficit improved dramatically in this quarter as China opened up a little bit. Although, who knows if they're going to stay open? They don't seem to be having very good luck with that. But I said it would add about 1.5% to GDP this quarter. Well, it ended up adding 1.43. So I'm gonna take that as a win. It's close enough in my book. But this time it was inventories. Inventories subtracted 2% from GDP this quarter. Now, if you think about that for a second, in a way, it's kind of a positive thing. There's a lot of people out there talking about, hey, companies have built up inventories and they've got too much inventory. We've seen that with Walmart and Target. Now, I'm not a big believer. Well, first of all, people talk about the bullwhip effect. The bullwhip effect actually is more about up the supply chain. So it's not about retail. It's more about wholesale and manufacturing level. So in the report, I looked at the wholesale inventories. But look, if we did have a big buildup of inventories in the fourth quarter, if you look at that GDP number, which was a plus 6.4, I think it was, a huge chunk of that was inventory build. So now we're taking that inventory, they're working down their inventories. So is that good or bad? Well, in my book, it's a good thing. I mean, we had too much inventory. If we're going to work it down, that's a good thing. But it does subtract from GDP. So again, you take out minus 2% on inventories, and you end up with a positive number on this GDP. So is the underlying economy still growing? I tend to think so. Are the official numbers showing that? No. Does it matter? No. What matters is, what matters. And I think that, when we look at the underlying part of the economy, it's doing exactly what we've said it's going to do. The good side of the economy was growing too fast. We saw this during COVID. Everybody shut down. Everybody they sat home. They couldn't go to dinner. They couldn't travel. They couldn't do all those service things. So they bought stuff because they had money. And so the good side of the economy went way above trend. The services side of the economy went way below trend. So what did we see in the GDP report? Well, we've said, look, the goods part has to come down. The services side has to come up. That's exactly what we got in this quarter. And in fact, it's exactly what we've gotten in the last 2 quarters. We had the good side of the economy contracted, the services side of the economy expanded. And by the way, the services side expanded more than the good side contracted. So you end up really with kind of a positive growth. It's exactly what we expect, and it's exactly what needs to happen. This is part of the inflation problem, is a supply issue because the demand for goods is above trend. We need that to come down to help with the inflation stuff. So look, everything is going exactly as we would expect. Look, I don't know if those things are going to just go back to trend and then just stay right on trend. In fact, that seems highly unlikely. It's more likely that the good stuff goes below trend and the services stuff goes above trend. You're still in the same place though. But my point is that, you gotta look at the report and really dig down into the details to see what's really going on with the economy. You can't just look at the headline. That's just not good enough.
So then we had 2 non-events last week, the GDP report being one, the FOMC meeting being the other one.
Yeah, and neither one of those things were unexpected. They were exactly as expected. In fact, the FOMC raised the Fed funds rate by 75 basis points. Is exactly what was expected. I think more important, and I said this, in the previous commentary, what's important is what he says at the press conference. He intimated that they are now what's known as data dependent. They're just going to watch the data as it comes in. They'll make a decision when they get to the next meeting. There's no so-called forward guidance here. I think that that's exactly the way it should be. And by the way, it's interesting how this happens. Everybody last week was like, because he said something during the press conference. He said that they were basically at neutral. Actually, he didn't even say basically. He said, we're at neutral on the Fed funds rate, meaning a rate that is not inflationary and not disinflationary. I guess it's neutral to the economy. Well, a lot of people push back and they're like, oh my God, how could we possibly be neutral when inflation is 9% and the Fed funds is 2.5%? Well, we'll see. We'll see who ends up being right about that. I suspect that in this case, Powell's more right than the pundits online. We did get, for instance, an ISM manufacturing report this morning. Within that report is something called the prices paid component. It went from 78 to 60 in 1 month. That's primarily, I would assume, to do with crude oil prices, which have come down a lot. But the bottom line is that inflation is fading away here. At least it looks like it's going to. Look, we've got 2 more inflation readings, the official numbers, the CPI, and 2 more CPI reports before the next Fed meeting, FOMC meeting. I would not be surprised if they get to that next FOMC meeting and they go, we don't really need to do all that much. But you know what? We don't make predictions here. We just wait and see how this comes out, and we can adjust on the fly. That's what we do. In other words, we're always data dependent in a way, data and market dependent. The market tells us what's going on too. And by the way, the market is also, in a way is saying that the economy is slowing. You've seen interest rates come down some. Last week, with Powell's comments, you did see inflation expectations pop up a little bit. I don't think it's going to last. We'll see what happens.
You've said for a long time, you expect the economy to come right back to where we were pre-COVID. And even after the GDP report, your opinion on the economy hasn't changed.
No, look, we came into this, we had grown at 2.1% a year for the previous decade. We did a whole bunch of stuff during COVID, but we didn't do anything that changed productivity growth. We didn't do anything that changed workforce growth. If you don't change those 2 things, you don't change the trajectory of the economy. And we didn't. I think some might make the argument that we did some things that make it worse. Certainly immigration has been an ongoing political issue. We do not see population growth in this country as we have in the past. But, we've got room to expand workforce participation. That could still go higher. And I suspect it will. It's going to take time. It was in an uptrend prior to COVID. I don't see any reason why it can't continue in an uptrend here. But that's another thing too. I've said this a number of times. People look at that workforce participation rate number and they say, well, it's falling. That's bad. Just because something's going down doesn't mean it's bad. What is the goal here as a country? Do we want 100% of people working? Well, of course not. I mean, we work for a reason. It's not just to work. We work to have a life. So I don't know what's the perfect workforce participation number? I don't have any idea. Is it higher or lower? Is the ideal one higher or lower than where we are right now? I don't know. We'll see. My point is, though, that economic growth is about those things. It's about workforce size and participation, and it's about productivity growth. We've got to do things to improve those things in order to increase our potential growth. We haven't done anything. We're seeing some preliminary things that may help on the productivity side. We've continued to see new business formation has continued to be high. It spiked up during COVID and it stayed high. That's good news. We've seen core capital goods orders continue to rise. We got a durable goods report recently that showed exactly that, up, I think, 13 of the last 14 months or 12 of the last 13, I forget what it is, but it's on an obvious uptrend. Those are good things, but they take time to bear fruit. So we'll see how things go. But right now, my expectation has not changed one bit. We're going to 2% growth, and how we get there, the path to get there, is something I can't predict. So that's where we're headed, and looks like we're well on the way.